NextEra Energy is a leading American energy company primarily engaged in the generation and distribution of electricity. The company operates in the energy sector with a focus on clean and renewable energy sources. Due to a massive guidance cut, NextEra stock has completely tumbled in the past week. The stock is down around 9% today, well almost 10% at the time of recording, and it has seen its price decrease by almost 20% in the past 5 days. If we look at the year-to-date performance, we can once again see that the stock has been absolutely hammered, it being down almost 40%. NextEra is liked by many investors due to their solid track record of dividend growth, and with the recent price drop, you are now able to pick up shares with a starting yield of over 3%. Let's move over to QuantView, our stock insight tool, to get a broader insight into how NextEra is performing. And as we can see here, the revenue has been in a slow but steady uptrend in the past 10 years. This trend, however, is something we don't see in the free cash flow numbers. This is because NextEra has to make a lot of investments, therefore increasing their investment cash flow by over 3 times compared to 10 years ago. This causes their free cash flow numbers to be suppressed heavily and pushes it into the negative. This is something we can then also see in the free cash flow per share. NextEra has another problem that is getting bigger every single year. Their debt burden has more than doubled over the past 10 years, while their cash position is always tiny. This can be especially a problem during the current high interest rate environment. They've been able to increase their dividends very nicely though, with an average dividend growth rate in the past 5 years at over 10%, and this is something we'll take a closer look at in the next segment of today's video. And by the way, if you want to get access to the stock insight tool and all of the valuation models that we will be using in this video, be sure to check the Patreon link in the description, where you can get your hands on a bunch of spreadsheets to enhance your investing journey. And with that out of the way, in today's video we will be taking a 3-step approach to thoroughly evaluate NextEra Energy and determine its fair value. Step 1. Margin of safety. In this step, we'll assess NextEra's key metrics and ratios to determine if we should be more or less cautious when determining a fair value. Here we'll delve into NextEra's financial statement and assess critical metrics and ratios. In step 3, we will be using a combination of valuation models such as Graham's valuation and the discounted dividend model to gain an insight into the value of the business. This step allows us to understand whether the stock is overvalued or undervalued in the current market based on different metrics. In conclusion, by combining the findings from the 3 steps, we'll ultimately determine the fair value of NextEra Energy as an investment opportunity. To determine this final valuation, we'll be using a margin of safety. This margin of safety will be based on financial ratios, the financial health, and the growth of the company. We'll be using a standard margin of safety of 25% that can never go below 0%. The margin of safety can either increase or decrease based on the ratios that we'll be looking at in just a moment. And the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green mean a 5% deduction, and bright green mean a 10% deduction. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green mean a 5% deduction from a margin of safety. The first 2 metrics that we'll be looking at are the margin and EBIT growth. As we can see, the EBIT has barely gone up over the years, going from $3.5 billion in 2013 to $3.7 billion in 2022. The average EBIT growth during this period is then only 3.8%, which is in the orange part of our scale, indicating no change in the margin of safety. If we then look at the margin, it has actually gone down over the years, going from over 23% in 2013 to almost 18% in 2022. The average margin decline during this period is then sitting at 1.2%, which is barely in the orange part of a scale, indicating once again no change in the margin of safety. The next metrics that we'll be looking at are the dividend growth and the payout ratio. The dividends have gone up very nicely over the years, going from 68 cents a share in 2013 to $1.80 a share in 2023. The average dividend growth during this period has been sitting at 10.5%, which is in the bright green part of our scale, indicating a 10% deduction in the margin of safety. This dividend is supported by a payout ratio that is sitting at 44%, which, looking at our scale, is no change in the margin of safety on this metric. Coming to the final metrics, we'll be looking at the debt to EBITDA and return on invested capital. To get our debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. And for NextEra, this is exactly 4 years in this case, then a 400% debt to EBITDA ratio, which is way past the red part of our scale, indicating a 5% increase in the margin of safety on this metric. The return on invested capital for NextEra Energy is currently sitting at 4.6%, which is not bad, but it's also not very good. And this means no change in the margin of safety on this metric. But let's go look at the valuation models next to determine the intrinsic value of the company. The first valuation model that we'll be using is the dividend discount model. I've imported dividend payments of NextEra Energy going from 2019 to 2023. The average growth rate in their annual dividends during this period has been sitting at 9.42%, and I'm projecting all of their future dividends to grow by 6%. I will be using a discount rate of 9% in this valuation, giving us a price per share out of this model of $63.25, which is an upside of almost 22%. The second model that we'll be using is Graham's revised valuation formula. In this model, we take a look at the earnings per share that NextEra Energy is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds that is always sitting at 4.4. And we go by the theory of Benjamin Graham that the PE of a company with no growth should never exceed 7. And if we look at all of these metrics, we get an intrinsic value of this model of $61.03, which is an upside of over 18%. The next model that we'll be using is the multiple valuation. In this model, we take a look at similar companies to NextEra, look at their stock price and their earnings per share. This way, we can determine the average PE multiple in the industry, which in this case is sitting at 18.80. And that's all that's left to do then to get our price per share out of this model is to multiply by the earnings per share that NextEra Energy is generating, which is $4.04 a share. And that gives us an intrinsic value out of this model of $75.96, which is an upside of 47% from the current price. And the last model that we'll be using is the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its mean, and the metrics that we use to determine this are the dividend yield and the PE ratio. In this case, I've imported the dividend yield of the past 5 years, and on average it has been sitting at 2.09%, while the current dividend yield is sitting at 3.28%, indicating that's undervalued in this metric. Doing the same with the PE ratio, on average it has been sitting at 29 over the past 5 years, while the current PE ratio is sitting at 12.79, indicating that's once again massively undervalued. This gives us an intrinsic value out of this model of $99.16, which is an upside of almost 92% out of this model. Now that we've gone through all of our valuation models, let's go look at the final overview of our valuation next. Coming to our final overview, we've imported the discounted dividend, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $74.90. We've determined our margin of safety before, using a standard margin of safety of 25%, deducting it by 10% for the dividend growth, and adding 5% for the debt to EBITDA, leaving us with a 20% margin of safety. Applying this margin of safety, we get a fair value of $62.41, and with the current price of $51.74, we get an upside of almost 21%, which means that per our valuation, it is currently indicating a buy. Now, if you want to get access to this valuation model that I use in these videos and all of my other videos, you can check in the description for my Patreon link, and you'll also get access to QuantView, our stock insight tool. And if there's any other companies that you would like to see me cover on this channel, please let me know in the comments as well. And thanks for watching.